Here's our next question from L. Wang, who says, if I have enough money for my retirement, is it wise to put 90% of it into treasuries and perhaps buy stock mutual funds with a 10% balance? So I think the question is sort of like, maybe let's sort of frame it a different way. Let's say I have plenty of money. I now want to preserve my nest egg. Mm-hmm. Now, should I go 90-10? Should I kind of like lock it down and pull the risk off the table? Jack, what do you think?
Well, the one definition of rich is when you don't have to take risk anymore. So I do see the logic there if her only worry is capital preservation. But I just don't like the idea of 90% into anything.
Yeah. Right.
We were talking earlier about how there is no such thing as a risk-free investment. It might be market risk in stocks, which is really obvious, but there's also inflation risk, which is less obvious but just as pernicious. So I think I would diversify.
Did everyone just catch that Jack said pernicious?
I knew it.
I can't even believe you said that. I mean, it's so impressive.
I love that word.
God, he's amazing. Liz, what do you think? Similar kind of don't want to put all your eggs in that basket either, even if it's a safe one?
Yeah, I mean, the problem is if she's close to retirement, she may spend 20 or 30 years there.
Yeah.
And if you're just sitting in treasuries, you're going to lose half your buying power, just assuming inflation is somewhere near historical norms. So.
Now, how would you feel if she said, I want to take a bunch of my money. Let's say I have $1 million. I want to take a bunch of that. I'm going to retire. I like the idea of a monthly income. How are you feeling about a fixed annuity for part of that money?
You know, I think fixed annuities can be a good solution for a lot of people. It's like creating a pension. I would just be very careful how and when you buy it. And I don't know that I'd buy one now just because rates are so low.
Yes.
Just feels like if you wait a few years, interest rates will come back up, you'll get a better deal.
Yeah. So, and we can talk more about annuities at another time. But the fixed annuity, I always like that as an idea. I like people I think that people tend to overestimate how well they will manage their money in retirement. And
That's
so
the thing.
For a while, it's nice to kind of have that consistent income. So
Yeah.
I'm a fan. Lindsay asks, I have my retirement account set up with Fidelity and TD Ameritrade, and these accounts are professionally managed. Get that? I have so many questions about that. I also have a separate investment fund that I would like to grow, and I am currently evaluating investment education, systems, and advisor companies. This evaluation task is proving to be a little overwhelming, as there are several firms offering assistance with varying fees and credibility. Can you offer any advice to help me narrow down my options, please? God, Lindsay, we can offer you so much advice. Liz, now, I am not 100% clear that those retirement accounts that are with Fidelity and TD Ameritrade are actually being managed.
I'm not sure how much professional management she's getting either. I mean, she is on the level of if she's invested in mutual funds, she's got money managers taking care of that. And I know that they do also offer advice. So
Yes.
she might be signed up with one of the advisory
Now,
services.
does TD Ameritrade do that? Or
That's
I
what
know
I was wondering, yeah.
Fidelity definitely does it.
Yeah, but I'm not sure.
I'm not sure either.
It's possible she's got a fee-only advisor who's put them...
Parked it at TD
Yeah.
Ameritrade. So let's go through this task of evaluating the flavors, the flavors of investment advice. So, okay, we'll go from like commission-based. Let's go old school to new school.
Okay, old school is the commission-based insurance agent or stockbroker. They are paid by what you buy. And a lot of people have a lot of discomfort with that idea. They might like the person, but there's always something in the back of their mind. Is this, benefiting him or is it benefiting me? And right now, these folks are not fiduciaries, which means they do not have to put your interests ahead of their own. The only thing they have to do is pick suitable investments. And there's a big gap between suitable and best. So that's the concern. And then you move up in the investing world. Everybody's trying to pretend they're fee-only these days, it seems. But a true fee-only advisor accepts fees only from you. They're not fee-based. Fee-based means they accept fees and commissions. Mm-hmm. Fee-only means you are the only one paying them for their advice. I am just much more comfortable with that setup for most people. The problem is most really good fee-only planners only deal with high net worth because that's the only way to make the
All right, and I will tell you
work.
that in my own business, when we tried to do it with the lower level of client, we got annihilated in terms of like how much money we lost.
Yeah.
We tried to roll out different ways to do it for folks who had, say, less than $150,000 or $200,000, and the business model doesn't work that well, and that's the shame of it.
Yeah.
I mean, you're in business, you got to make money, right? But But what you can find sometimes is you can find someone on an hourly basis who can help you out.
Yes, the Garrett Planning Network was the real pioneer in this. It's Cheryl Garrett out of Kansas. Love those Kansas women.
Oh my God, Megan is having a baby right now because of Kansas.
Awesome Midwestern folks, running the country. They should be anyway. So anyway, she put together this network, and that's exactly the model. They act like a dentist's office. They want you to come see them, regularly, but they don't want to manage everything you've got. They want to give you advice and have you execute. And I think that really does work for the middle market kind of folks. It's not cheap. I mean, it's, $500 for a portfolio review, maybe $1,500 to $2,500 for a full financial plan, which to middle-income people, that seems like a lot of money, but it's a great investment to get that kind of professional advice to get going.
And it's really important to note that it seems expensive because they can see it. It's transparent.
That's it.
If you hire a broker and, I don't charge anything. But of course, there's a 5.75% fee for every mutual fund I put you into. And meanwhile, he's going to put you in, funds that have annual fees of 1.5 percentage points, as opposed to Garrett puts you in an index fund, which is practically free by comparison. So people should evaluate that cost based on what they would really pay with someone else, not what they would think superficially they'd pay.
Great point.
And it also depends what you need, because if you want real financial planning and you have enough money to have like bigger concerns than that, then maybe an hourly or a fee-based advisor will work. But if you did, I will make one case for commission-based people, because I got nailed when I said something on a podcast recently that like, oh, that's ridiculous. Who would do that? But there is a case to be made, and here's your case. You are just inherited a boatload of individual stocks from your grandmother, and you're basically going to hold them, and you would like a little bit of advice along the way as to when you might sort of execute transactions here, there, otherwise, and then a commission-based place where you can just have an account where it's held and pay based on the transaction works.
Yeah.
Okay. Now will our sponsor be happy with that? We don't have only fee-based and fee-only advisors who sponsor this podcast, Jack. We have a couple of, I hope that helps, Lindsay, and we can certainly help you out more. But again, commission-based, fee-only, and hourly. Those are kind of your combinations. Ask questions, and if it doesn't feel right in your belly, don't do it. Right?
Absolutely.
Okay. And by the way, it's not like how many rounds of golf you play. Not in the equation. We have a couple of insurance questions. Cynthia, my mother, who will be 79 in 2 weeks, mazel tov, and in great health, knock on wood, has a universal life insurance policy with a death benefit of about $80,000 to date. What are the ins and outs of getting the maximum cash available without surrendering the policy?
Oh, this is over my head.
I got it. I got this one. You know this one? I just sometimes like to show off that I still know stuff, Stuff.
I guess I would say you have to tell it to, it's not a bad place to get some cash if you really need it. But on the other hand, maybe the debt. It really depends on what this woman is going through.
That is the biggest punt I've ever heard, but I love you for it.
For instance,
I totally love you. I'm in love with you.
One could hypothesize about older folks who might have dried up their savings.
Yes.
And now they're looking for places to go. Is it a reverse mortgage? Do they sell the house and either rent or downsize? So if those are all the options, then I think tapping a life insurance policy, if you don't expect to leave your heirs too much anyway, that's a good way to go.
Here's where you go with it. You get a loan. You execute a loan against your policy. It's awesome. It's very easy to do. You borrow the money out. Because if you just blow out the policy, you're right, you're done. So if it has $80,000 of cash value, it's a $200,000 death benefit, and you've got 80 grand in there. You're like, I'd really like that 50 grand. You execute a loan against it. You borrow 50 grand out of it. Okay, it's yours.
I think that's what she's talking about, right?
And she says, "What? How do I get the ins and outs of the cash?"
I see.
Right. So here's what happens: when you die, your death benefit is reduced by the loan amount. That's it. Very easy. Piece of cake. Easy to do. Not a great thing to get involved in if you're young and you really want to maintain a policy. Now, this brings up a whole other, question of why did you have the insurance to begin with? You don't take a loan out if it's for purposes that would be estate planning purposes. You cannot take a loan out if it's inside of an irrevocable insurance trust. So there's all sorts of things that you can't do with it. Talk to the agent, get the loan, follow the rules. Don't let it lapse.
That was my question. Is there a chance of it blowing up or collapsing?
It is. There is. Universal life, less so than variable universal life. Because if you have a variable universal life and all of a sudden the stock market tanks and all the sub-accounts are invested in stock market, you could have a problem.
Yeah.
But in universal life, it's basically an interest rate product, right? So it is a fixed, it can go down, but it can't go less than zero.
Okay.
Thank God. That's one benefit there. Hey, I just gave insurance agents like a good
There you did.
possible
Yes,
sell.
absolutely.
Hey, we can't go less than zero. It's awesome. So it resets usually annually. And it basically it's like an interest rate instrument more than anything else. But universal life, I happen to think if you really do need permanent life insurance, you need a policy that's going to last your entire life. I think universal life is actually the right policy to choose. I'm not a huge fan of whole life. Sorry. Did we want Northwestern?
One thing, if the dividends are paying the premium by taking out a loan, do you mess
Yes,
that up?
you do.
Okay.
But my guess is that I'm assuming, and I don't really know. We don't know what the death benefit is. They should be fine. And then what you can do is you can say to the insurance. The thing that is amazing about insurance agents is they have a really terrific way to run numbers because they have the actuaries of the organizations. So they can go back to the organization and say, all right, here's the deal. They don't want the policy to lapse. She's 79 years old. Use this implied interest rate. Oh, yeah, I know I'm getting 5 now, but use 2 and tell me what the maximum loan amount is. And then they'll spit it out in a spreadsheet. It comes back to you in 2 weeks and you have the information. It's kind of cool.
Yeah.
All right. Robert in Arizona. What do you think of a relatively new type of insurance policy that offers life insurance protection and long-term coverage in one contract? It's typically a universal life policy with a rider that frees up the death benefit to pay for long-term care if you need it. But if you don't, your beneficiary is paid the death benefit up to twice your premium, income tax-free when you die. Its appeal is that it eliminates the biggest objection to traditional LTC insurance. Okay, can I just answer this because I know this? This is a product called Golden Rule. Have anyone ever heard of it? It's like actually an amazing product. It is so complicated to sell that even if it's the most amazing product that's viable and it's expensive, and by the way, you get an awesome commission for you brokers out there, because I have sold a few in my life. But it is so. Can you imagine? We just like put together a whole bunch of concept here, right?
Yeah.
What it really is doing, it's allowing you to take a piece of a policy that builds up cash value and use that for long-term care insurance. And that if you burn through your long-term care insurance, then, and you use up, it sort of keeps you in a long-term care facility or need for, say, 3 to 5 years. If you need it beyond that, this is not going to serve you. It's not.
But most people don't need long-term, truly long-term care.
So it's a very cool product. I don't know what Robert is. It's not even relatively new. It's probably about 10 or 12 years old. And it's from one of those Midwestern places.
Oh.
You live by the Golden Rule kind of thing.
Oh, there you go.
Megan,
Okay.
I think it's probably something in Kansas. Megan's going to sing the Kansas fight song later in the show. So it is kind of a cool thing. But give us the but.
I'm jumping in here because the problem with a lot of these insurance products is, they're kind of gee whiz and wow, this is great. The thing with life insurance is you need to have enough. And so many people I talk to get so, starry-eyed about all the features of these different products that they don't realize they can't afford to buy enough. And that's why most people need to default to term insurance. No, it's not permanent. There's no investment component. There's certainly no long-term care attached. But if you need life insurance, you've got to make sure you have enough. And for many families, the one thing they can't afford is term. So,
and I think that's an excellent point. And for most families, you don't need permanent insurance. You need it for a specific period of time. Did we not have this conversation about the Otter family recently?
Indeed. And we should explain what that need is. The need is to replace the salary that would be gone or the income that would be gone if you were to die. And that could be a big number if you start thinking about what happens if you keel over tomorrow and you've got children to put through school and nannies to pay and mortgages and everything else. But a lot of those costs are going to dry up in 20, 15, 10 years, depending on your age.
Yeah, exactly. And if you've got enough money that a universal policy is going to make sense, you've got enough money to go to a family planner and get a second opinion on it.
I like that. Very touche. Should my goals guide my spending or should my spending guide my goals? This is some sort of existential question,
Yeah.
which requires probably different paraphernalia than we have right here. The reason I ask is that some of the advice I have seen on personal finance planning implies that budgeting should be the central concern of everything you do. What about quality of life? Liz?
Absolutely.
You're not going to make these people live like paupers and not have any fun?
What drives me crazy is people that think that, it's not all about balance. What you get when you have a budget that actually works is balance. You get to live your life today. you get to pay off your past if you have any past hanging around, and you save for the future. And I talk in my book about the 50-30-20 budget that Elizabeth Warren came up with. So freaking simple. I wish I'd thought of it, and I wish I'd thought of it 20 years ago.
All right, give it to us, baby.
Okay.
50, 30, 20.
50-30-20. You take your after-tax income. Okay. And that's
So for you, it's $1 million.
something like that.
Right.
Not your net pay, because people get confused about that. It's your after-tax income. Half of that is what you should be spending, and no more, for the must-haves. And the must-haves are things like shelter and transportation, childcare, minimum loan payments,
Wine.
insurance.
That's a must-have.
If it's a must-have for you, bless you. You put it in there. So, if you limit that to 50%, if you limit that overhead, and what a must-have is basically something you cannot put off for more than a month or two. Or, I mean, not even for a month or two. It's something that you actually have to pay, or there's consequences. If you limit your overhead to that amount, then you have enough room in your budget to have some fun. And the wants are the 30%. That's vacations and travel and clothes and eating out and fun. And then you have 20% for paying off any debt that you have and saving for the future. And it's remarkable. It works for every income. And it even works in New York. I keep hearing people from New York saying,
You see, look at Jack.
I was just
Jack
thinking maybe
is-
80, 10, 10.
Jack is sort of like looking there. I don't think so.
yeah, 40% of my income is going for my rent. How do I make this work? 40% of my gross is going for, and
Right.
we have the same situation in LA. And I understand it's really high cost. But if you can get either raising your income or lowering your expenses, if you can get to the 50-30-20, you've got that balanced life, and you don't have to worry about, starving now so that you can be rich later, or blowing it all now so you can ride the bus when you're 80.
Now, can't we just say that this is your 50-30-20 rule? Do we really need to cite Elizabeth Warren?
She's the one that came up with it. I mean,
So honest.
Lord, here I am. I'm about to just tweet this. All right, but so
it's in the book, so, yeah.
okay. So, and we'll plug the book. Don't worry, we'll get there. I mean, come on. The 10 Commandments of Money, starring Charlton Heston and Liz Weston. So when you think about 50-30-20, though, and let's say, like we have young folks who, like our Sally here, who is running our board, who is living in New York City as a young, struggling 20-something. I think she's like barely 20-something. And it is expensive to be here, but she thinks in the future that she will be making that money. So can you blow through that for a couple of years, or is it like hard and fast? How do you feel about it?
The first time I did it, our must-haves were at 65%. And what that taught me was two things. We needed to reduce our expenses and
Get rid of the
increase
dog.
our income.
You had to kill the dog. It's too bad.
We just got a dog. Oh, let's not get started.
So you think a couple of years, it's okay. It's a good goal.
Short term, it's fine. But the thing is, you're going to be out of balance and you're going to feel it. Something's got to give, and it's either going to be, you may be racking up credit card debt. You might not be saving enough for retirement. And I'm really hardcore about retirement. It's got to come first, no matter what. And too often people think I can just put it off and do it later. If you wait much beyond age 35, you're really never going to catch up. I
Did you
mean,
hear that, Megan? 35.
sorry. TikTok.
By the way, somebody here in our chat room, if you want to go to the chat room, go to MoneyWatch.com and you can chat with our bosses, number one, and other people who are there. Someone said, my budget makes me feel calmer and able to enjoy my life.
I like that.
Isn't that interesting?
Yes.
That's kind of a cool thing.
It does free you up. I mean, once you say, okay, this money is allowed to be for food and wine and clothes. Hey, great, I can spend it, because
Yeah.
the other things are covered.
I think of
rather
it like sort
than
of like
every expenditure.
And I think it's sort of like diet. Like you don't want to be on a crash diet because then, all of a sudden you're going to go and splurge and do something wacky. So I think that's a great idea. Love that. William, excellent question. Here we go. Chip owns his own company. He writes to us with this question. My company offers a 401k, plan assets just under $1 million. Two issues. First, we receive virtually no investment advice from our financial advisor. Let me do this. Financial advisor in quotes, who, as far as I can tell, is merely fulfilling the part of a broker or as an insurance broker. I believe that he even told us once that he's not allowed to give us investment advice. As a result, we're left on our own to pick investments, which none of us are qualified to do. When I look at the plan, most of our employees are allocating their investments to the money market account that's offered. I believe this is a non-strategy that is doomed to be overwhelmed by inflation over the wrong one. Can our financial advisor provide advice? If not, what should I do to get our employees investment advice that will help them invest their savings wisely?
Oh, well,
great question, though.
Awesome question. And so many red flags went up as you were reading that. I mean, the plan is so freaking small. You are not going to get the same level of, support you would get from a Fidelity or T. Rowe Price or whatever. But I really would shop it around. Oh my gosh, if it's with an insurance company, you've got the problem of, maybe you've got investment options that are just really expensive, and are going to cost your people a lot of money. And there is more competition now for the smaller plans. So I'd really urge, if they haven't shopped it around in a while, to do that. And there are some, some off-the-shelf solutions. Financial Engines is something that comes to mind that offers advice. There are ways to get advice.
Yeah, the thing is that it's true that you're really not, but it's an ERISA law. You're not supposed to give advice to plan participants. Even if you have a humongo plan that's at Fidelity, you call Fidelity up and you say, what should I invest in? They'll say, we can't provide investment advice. But I think what you might want to do, which is kind of a cool idea, is you get someone like Liz or Jack or me, or you get someone who's in the business but not trying to sell you something, to come do some speaking engagements for the company. Why not? I mean, this would be a nice thing for you to do for your employees. At CBS, they had me do it for CBS News. I did big seminars and we put them on video and we keep them available. And what it does is just sort of helps people understand what they have and how to use it. Now, each person has to make individual decisions. This goes back to a longer conversation about how we don't really have financial literacy in this country, and that's such a problem. And we talked about that last week actually with one of our bloggers. But it's something that as an employer, if you really do care about your employees, it would be nice to just hire a third party, find an hourly advisor who will come and say, I'm going to give you $500 to come in and I'll give you lunch, and can you just do a little seminar for my people? And I think that's not a bad idea. It won't give them ongoing advice, but you're right. Shopping the plan around is a good idea. It's just hard with those types of plan assets.
I got 2 more ideas.
Go on, baby.
You can buy every employee a copy of The 10 Commandments of
Oh,
Money.
my God.
Jack.
Wow, that's awesome.
And, of course, MoneyWatch.com.
Every day.
Yeah.
And my blog specifically, by the way. Okay.
But actually, there really is decent advice out there. And if every one of these people in the money market went to a 60% in an index fund and 40% in a bond fund, not the fanciest plan in the world, but they'd be a lot better off.
It's funny because the second part of the question is that he says that he's trying to find more investment options. He says that a lot of these plans are very expensive, but, he said that, is there a competitively priced 401k out there that can offer a wide variety of investment options? The insurance product funds that my plan currently offers, a good thing or a bad thing? See, here's the problem. When you have a small plan, you usually have your buddy is a broker and he finds you a 401k plan. I totally get that. And it is very expensive to go out and find these plans. And so the insurance option is not a terrible one. They're usually kind of expensive for the participants, just got to say. And the other piece of this is that don't get so crazy with investment options. In the 90s, people had 50 different investment options.
And they froze up.
Exactly. So, make sure you have a bond fund. Make sure you have a stock fund. Make sure you have an international. Be nice to have emerging markets. Have a couple. If you have a few different flavors, you don't need more than 6.
And a target date fund.
Yeah.
Oh, yeah.
That'd be good. I'm not so crazy, but yeah.
Liz likes them.
I know. I like them, but, you got to look under the hood. That's the problem.
Totally. I like them for people just getting started. So they just get off their butt and do it.
Yeah. Here's Anonymous, who I think works at CBS.
Oh, wait, can I throw in one more idea?
Oh, yeah.
He should make it the default option.
Yeah, the default option, instead of being money market,
Right.
could be a target date fund.
Yeah.
And you can change that on the employer side.
Right.
Right. That's a great idea. Jack,
Awesome.
ring the bell. That was a good one. Here's someone in the chat room says, as a plan participant, how do you know if your 401k is a good one?
Oh.
Liz, did I just tee it up for you? Come on, slam that down.
Oh, well, I'm going to need some help with this. But you know what? If you got a big company and they have a big company plan, chances are it is pretty good.
Except at CBS, which sucks.
That's funny. I was going to say, chances are, if you have a 401k, it's bad.
No. Because, a lot of people get pitched when they leave a job to roll over their IRA. And the reason that the brokerages and the mutual funds companies are doing that is because they make more money on the retail investments. The nice thing about a 401k with a big one is you tend to get access to the institutional funds. See, I'm all about cheap. I want it cheap,
you, babe.
Low expenses. And, the problem with the big company funds is exactly as Jill said. They just have too many options and people freeze up. But I think that, you can do pretty well. Where I start to worry is where you're missing some big chunk of the market, or the expenses are much over 1%. Even 1% makes me cringe for an ongoing expense because I know there's other hidden fees that you're not being able to see.
How about transparency? Wasn't there supposed to be transparency in 401ks? What happened to that? What happened? I thought that wasn't that part of like financial reform?
I think it has improved. In some of my old 401ks, which I should have rolled over, they've now started to show me the fees that I'm paying, which is encouraging me to roll it over, in fact.
Right.
I think what I was addressing is that it used to be that fund companies would put their stinkers in the 401k as a great way to gather assets. They're getting better about that, and there's more and more index funds in 401ks now.
Yeah. And one of the things that you can do is like you can call the plan the plan that's sponsoring this and say, what's the cost of this? And they'll say, well, you could refer to your prospectus. And you could say, no. Why don't you just tell me? Because, you're going to get this 100-page legalese document. You don't want to go through it. It's like on this little onion paper, some evil lawyer in Boston has just drafted this for Fidelity, and they know how to write it. But you can just ask someone on the phone. And then they will tell you, and they have to tell you. They may not tell you what you should do, but as Liz and Jack have both said, an index option inside of the plan is really good. And if you're in a large plan with a large employer, you get a bunch of your co-workers together and you say, wow, this plan stinks. Or you do what I did, which is leverage somebody who is in a situation where they cannot evade you. Corner them. Once you find out that they have anything to do with corporate benefits, which I did. And I said, why does our plan suck so badly? Like, we're a huge company. We can't find something better than the current plan? Like, really? And he said, oh, we know. Okay, that we know is not.
Know.
We know is like we know, and we're going to replace it. Great, but to me, if you are a huge company, and you've got a massive number of employees. In fact, Hewlett Packard just consolidated its entire retirement platform on Fidelity. 160,000 participants. You don't think they got Fidelity to drop their drawers on expenses? I mean, come on. So, in my mind, if you're working for a big company and that company is not in a plan where you're either in zero price, Vanguard, Fidelity, or some sort of Schwab option, I think that they are not doing their employees a service. I really think they're doing their employees a disservice. Yeah. So, I mean, I get that there's a neat option to have an insurance company and have an annuity option within it. That's great. But you can have that also.
Yeah.
Like there are a lot of universities who have TIAA CREF alongside Fidelity as two different choices. Yeah. Right?
Sure.
All right.
That's a good plan.
This is so exciting. I can't even stand it. Hear that? Do you hear that gong?
I did.
That's someone from Kansas's very nice and proper way of saying that you guys have got to shut up. Let me just do this again. Liz Weston, you're awesome. Fantastic. What is the ability of you to Skype in with us sometime?
Oh, anytime.
Wouldn't that be fun?
I would love that.
And then you can tell us about all the cool things going on in L.A.
And you can see my dog, Trevor.
What kind of dog?
A golden retriever, of course.
Oh, my God. This is Americana. What the hell am I doing here? Okay, Liz Weston, don't forget, go out and buy her book. It's The 10 Commandments of Money. Did you ever think about perhaps releasing this around Easter or Passover? That might have been a better marketing strategy.
And better weather. Thank you very much.
There you go. Anyway, check out her question and answer column, Money Talk, and read her columns twice a week on MSN Money. It's a competitor, but we love her, so it doesn't matter. So thank you so much. You were great.
Thanks,
really great. You'll come back. Jack, you were pretty good.
Oh, thank you. Next time I'll bring bourbon.
Jack, you are always great. You're the best. We love having this show. And if you've got questions, and we didn't get to your question, we got so many questions because Liz is a rock star. So we'll answer them next week. If you have more questions about things that we're not covering, just send them to us. We always get to them eventually, okay? So don't worry. Now, as our outro, Megan, pay attention. As our outro, this is dedicated to Liz Weston because she really happens to like this particular artist. It has nothing to do with money. Thank you for watching. Check us out next week on MoneyWatch.com's Ask the Experts.